Day trading presents you with the opportunity to make a lot of money in a short amount of time. And by a lot of money, I'm talking about ROI, the percentage you make on what you trade. The average investor makes about 8% per year, but on a day trade, you can easily make 100% within a day. I'm going to show you an example here. You can see that I bought and closed a trade on the same day, August 22nd. I spent $1,200 and I came out with $2,000. That's almost double. And all that is trading this one day, this red candlestick downward. Based on my methods, I was quite confident that this would go down, and I did the appropriate analysis to make sure that this was an adequate trade. So, what is day trading? The definition of day trading is opening a trade and closing a trade within the same day. If you do that, that's literally the definition of a day trade. And you need to know that because if you have under 25K in your account and you day trade every day, if you day trade more than 3 days within a 5-day frame, you are going to be flagged by the SEC as a pattern day trader. That's fine if you have more than 25K in your account, but if you do not, you've got to be very careful about how often you day trade, because being flagged as a pattern day trader with fewer than 25K in your account presents many problems. Now, I tend to day trade options, and there's a reason for that. Options gives you leverage on your trades without the risk, and it requires less capital than you would need to day trade on stock. Now, one reason a lot of people are afraid of day trading is that there's a misconception that day trading is riskier than investing. Why that's a misconception is beyond the scope of this video, but I'll just tell you it's simply not true. You can day trade just as safely as you can invest, maybe even more safely. So let's get into how I day trade. Usually what I'm going to start with is a general idea of where the market is heading. You can do this a number of ways. I usually start looking at the futures before the market opens. You can go to Seeking Alpha for this information. It tells you what the stocks are looking like pre-market. And also you can look at things like seasonality. So in this instance, currently, we are in late October. And late October typically tends to be a pretty good month for the stock market. The market tends to head upward. Now, I generally want to trade in the direction of the market. So I generally want bullish day trades, but that's not always the case. You can also hone down on certain sectors that are more likely to do well than other sectors. So even if you know that the market in general is going up, that's not true for every sector. Now, since this video is coming out in late October, I'm going to show you a few sectors that tend to do good in late October and would be good choices for you to use to locate stocks for day trading. I'm going to show you 4, and then I'm going to point out a couple other ones. You can look at these indexes. First one is the Computer Technology Index. Tech tends to do well, starting late October. You also have the Broker-Dealer Index, the North American Telecommunications Index, and semiconductors. No, that's not the right one. Stocks. Semiconductors. These all tend to start to do very well at the end of October and are great times to look at stocks within those indexes for day trade opportunities. Another couple ones are the industrial sector and the financial sector. So generally I'll narrow down to those sectors and I'll look for stocks that meet my criteria. We'll get more into my criteria later, but you don't have to follow my criteria exactly. In fact, if you want to become a day trader, you've got 3 methods to do it. One is you just go about it. You kind of flail around in the water until you figure things out. That's going to cost you a lot of money at the beginning because you'd have lots of failures and lots of mistakes. but it might be a good way for you because you'll come out with your own methods. A second way to do it is to learn from someone else who already day trades successfully, but you're essentially copying their methods, so you're kind of reliant on that person. And the third one is if you have a trading background or a coding background, you can backtest day trading strategies to see what works for you. That's how I got into day trading. Now, before I even get into choosing a stock, and I know that I'm day trading, for example, next Monday, I'm going to check the economic calendar, which you can find at marketwatch.com. This is going to tell you what news is coming out. Financial news often affects the market. On Monday, nothing's coming out, so I don't really have to care about that. But, for example, on Tuesday, you're going to need to be careful at 10 a.m. You might want to wait until after this comes out, because existing home sales changes. If bad news comes out, that could shock the market. Good news comes out, it can move the market upward. And it's really hard to predict this leading economic data. But I always want to make sure that if something's happening on the day of the day trade, I want to know when it's happening. Now I'll get into choosing a stock. Usually I'll go to FinViz, which has a stock screener, and I'll look for a signal I like. Now everybody has their own choices. I find that these head and shoulders and head and shoulder inverses, and also the double bottom, double tops tend to be pretty reliable for narrowing them down. Today I was looking at wedge down, which is actually a bullish signal. Wedge down is saying that the stock is heading downward, but there's a support level, and there's a large chance that a stock that's heading down in this sort of pattern will break out upward. So you have a kurtosis trade there, where you can make a lot of money on a single trade. So I was going through this wedge down signal, and I arranged them by volume because higher volume stocks have tighter spreads, which means that it's easier to get in and out of a trade at a fair price. So I'll just start at the top and I'll run down through my analyses for each of these. My analyses include things like statistical signals, the seasonality of the stock itself, whether it's an ETF, exchange traded fund, or a stock. Exchange traded funds that are leveraged tend to have negative decay, so they're usually better played in the downward direction than the upward direction. But I'll look at all of this and I run my back tests on these, and if I find something that's in line with seasonality and has a strong seasonality in a certain month, then I'll start to drill down as to how I'd like to trade that as a day trade. So for this example, I believe I am going with, I liked this one. CHKP, Checkpoint Software Technologies. And the way I arrange my FinViz settings, you can click on settings to change your settings. That changes these columns you're looking at. But what I tend to look at are these that you're seeing here. Now, one reason I do this is so that I can arrange them by volume. But I also want to trade something that's somewhat adequately priced. I don't want something that's a penny stock. Penny stocks are defined as stocks under $5, and those are hard to day trade because you need to buy a lot of options on those to make a profit, and each option costs you money. Now that there's zero commission trading, you don't really have to worry if you're playing stock, but for options, you still are paying for each option contract. Also, I want to look at the earnings date. You don't want to trade after earnings because things are crazy after earnings, but we don't have earnings here until October 28th. Also, some stocks have earnings drift, pre-earnings drift. So if the earnings date is coming up, it's something you might want to look at. That's also outside of the scope of this video. I have a earnings newsletter called Exposing Earnings, and you can check that out. But once I locate a stock that looks good, I see if there's an entry point. And you can use technical signals. For example, when we were looking at, one of my students asked me about J&J, Johnson & Johnson. Johnson & Johnson fell a lot the other day because of some sort of asbestos in baby powder being recalled. The baby powder is recalled because of an asbestos problem. So you can see we have a huge down gap here. And he was asking, is this a good time to buy? So I ran a bunch of back tests, and one thing I found was a really reliable entry point for this stock in particular. And by the way, I run my back tests on each stock. So if you have some technical signals that you like, they might not work on every stock. They might be reliable for what you're looking at, but I really recommend you backtest or at least eyeball and see if it works. I'll show you how to eyeball in a minute here. But what I found was if you compare the exponential moving average of with a 7-day parameter to the 200-day parameter, that crossover is a pretty strong buy signal for this stock. So we'll see the EMA 7 is the blue line and EMA 200 is the red line. And when that EMA 7 moves above the EMA 200, that's a pretty reliable buy signal. And you can see here, if you had bought right here, you would have rallied quite high. Now that's more of a swing trade, but it's the same issue here. We saw it cross, it went up a bit, but then we got some bad news. So if you're looking to buy J&J, and I think it's actually a pretty good buy right now, but I'd still wait for that EMA 7 to cross above that EMA 200 before getting into a trade like that. I also have some models that tell me the probability of how a stock's going to move on a day. So this is my default entry point. One thing I look at, for example, is we're looking at Checkpoint software. So for Checkpoint software, I look at both the probability of a movement and the expected value of a movement. You can Google expected value. It's a statistical term, but it essentially means what you get, what you are going to get on average for playing this way. You're essentially multiplying the probability by the expected size of the movement, and you'll get a bunch of numbers. And I always want to play those best numbers, but sometimes I just want to play something that's very likely to move in a certain direction. Now, for this particular stock, one thing I found that was likely, we're just talking about probability here, not expected value, is that if you see a black candlestick, if you buy at the end of the day, a red candlestick in this case, if you buy at the end of the day, you have a 78% chance of the stock opening higher the next day. Now, it's not the best play here because those movements are a little small. But you can double check. You can usually eyeball this stuff even if you don't have the ability to backtest. You can just check it out. So, here's an example. Red candlestick, buy at the end of the day. It opened higher the next day. You could take that little bit of profit. Red candlestick, drop it down here, open a tiny bit higher, you could take that little profit. Red candlestick, opened higher the next day, that's still profitable. Again here, close, the opens higher, close, here we have the opens lower. So you had one day you would lose money, but you can just take this general strategy and trade that way. But this is not technically a day trade, this is what I call an overnight trade. You're buying at the end of the day, and then you're selling at the open the next day. This is actually quite profitable, and if you go to that site that I was showing you my results of, just simply damonvero.com, you'll see that I made a few overnight trades in this list. So look that over. Should give you some idea of what an overnight trade is capable of. I like both day trades and overnight trades, but we're talking about day trades here because it's a lot more interesting for most people. Many people like the idea of day trading. So I'm going to do back tests before I get into a day trade, but I have a general default plan. So let's say I intend to trade this Checkpoint stock. Well, what I've found is the most profitable trade is actually in the downward direction, and it's when you play an overnight trade on a white candlestick. So like I said, black candlestick, buy at the end of the day, take profit the next day at the open. You're making reliable but small profits. However, if you're going to do the opposite, buy at the end of a white candlestick, and so you're shorting at the end of the white candlestick, and then you're taking profit, you're covering the short on the next day at the open. That's a more profitable trading strategy, but it's less reliable. The probability for this trade is actually only 55%. It's basically random. But the reason this is the best trade for this type of trade is that the movement, the down gaps, are bigger. So you can see here, here's an example. This white candlestick, if you were to short it at the end of the day, you've got a large movement compared to those red to green trades. So this is the type of stuff I'm looking at for overnight trades. But in some situations, let's say we insist on trading this as a day trade. We want to get in at market open and get out at market close. What I see best right now is that if the stock opens high, higher than the close, you buy it and then you sell at the end of the day. And you can see many situations here where that's true. So from here, the next day, the stock opened higher. If you had bought and sold, that's a pretty decent profit. And you can go through this chart and look, and you'll see that those are bigger profits. But again, not as reliable. This is a 58% chance of making a profit, but the profits are the largest. So for day trading. So again, buy here at the end of the day, and then, buy at the beginning of the day because it's up gap, hold through the day, sell. That's a decent profit. And now we want to narrow it down, because day trading for most people isn't buying at the end of the day and then selling at the end of the day, regardless of what happens during the day. Lots of people like to narrow it down. What we're looking at here are one-day candlesticks. But when you're day trading, I tend to look at the 15-minute candles. So let's look at an example of, what am I trying to show you here? Well, let's just look at how I trade these last 4 days. Alright, so if you see these small candlesticks, this one is, you can see at the top, open to close. It's technically a red candlestick, very small red candlestick. But a red candlestick, in this case, tells me that it's probably going to, alright, we don't care about that, actually. What we're looking at, we don't care about the candlestick colors because we're day trading through the day. So ignore this one and we're going to look at this one. So here are the general rules I found for trading this stock during the day, which means you're buying it open. Buy it open on an up gap or down gap. Down gap, however, no, buy it open on an up gap. Down gaps don't move much. So let's see. Clearly this is a down gap. It's not going to move much. I would just stay out of this trade the whole day. And that would be pretty smart because it really didn't move at all. Here's an up gap. And usually you'd want to buy here, but this one failed. Here's an up gap. Usually you want to buy here. And it did go up, but then it dropped. So if I'm going to just play by buying at the day it's open and then selling at the close, it's not going to be reliable, especially if the probabilities are around 50%, like for this stock. For other stocks, you can do exactly what I just said, but usually you want to look at other things within the trade. And what I'm talking about, what I use personally, are these two things. Candlesticks, 15-minute candlesticks, and stochastics. Candlesticks are patterns. They show you how people are buying and selling. And there are reliable patterns in candlesticks. They can tell you which way a stock's going. Likewise, stochastics can tell you the best entry or exit points, because they're essentially measuring when a stock is overbought or oversold. There are other things you can use, like RSI or MACD, but these are my two go-to technical indicators. So let's drill down to a certain day. Now, this looks messy, but remember, these are 15-minute candlesticks, so you really only have to check this every 15 minutes. Now, I'm going to be looking for a couple things. First, I want to see the stochastics cross under these two lines. This is the 80 line, this is the 20 line. If the green one crosses above the red under the 20 line, that's a buy signal. And you can see that this is a pretty good buy signal if you understand candlestick patterns. This green candlestick sits within the red candlestick. That's called a bearish harami, or bullish harami. But you can also see that the shape of this candlestick is like a hammer. And a hammer with the hammer on the top and the stick on the bottom, at the end of a downtrend, usually signifies a reversal. So that candlestick pattern plus those stochastics crossing is a very strong buy signal for me. So at that point, this is a really good place to buy for a day trade. Now that you buy it, this second candle confirms the uptrend, and you keep watching the candlesticks. This one looks a little dangerous, but it's messy. It's not anything clear. Then after this, but I'd start to worry here, right? But after this, you see another hammer, which is pretty good. The reason hammers are bullish, hammers of this type are bullish, is that the shadow down here shows the strength of the bears. Shows how far the bears can push the stock down at that point. And if it can't go further, and if the bulls push it back up, the bears usually give up. So we'll see the bears are trying to push it back down again. They give up. Bulls buy. We got a little doji star here, another hammer. Bulls are trying to push it. Bears are trying to push it back down. Didn't work. Now we got a big green candlestick. That's called a bullish engulfing. And again, we got that uptrend. And then that's the end of the day. This is the next day. This candlestick is the next day. So that's the end of the day. You'd get out at the end of the day. And you'd also probably want to get out at the end of the day because you can see that those stochastics crossed again. And that's your sell signal. So that's a pretty good example of a day trade using just candlesticks and stochastics. But like I said, you're going from macro to micro. You're looking at the general market direction, you're looking at the sector direction, you're looking at the economic calendar, you're choosing a stock based on its seasonality and other technical signals. Then you have a default idea. If the stock opens high, what's it going to do in general? If it opens low, what's it going to do in general? Then from there, you narrow it down to these technical aspects so you can get your best prices. And then you get out. So, again, if you want some examples of how my day trades have worked out, go to damonberry.com. I've updated it with day trades and overnight trades. These were requests. Generally, my newsletter doesn't get into this stuff because it's too time sensitive. Usually we're doing swing trading or gap trading. However, you can gap trade and day trade at the same time. There's no reason you can't. You can see there's a gap trade here, and I believe I also turned that gap trade into a day trade. But if you have questions and you join my newsletter, send them on over. I'll help you out. If you are time sensitive with a certain day trade, you can come to Exposing Earnings and I'll be in the live chat. I can help you out.